Hi everyone, today we're going to be running through the methodology of a flex feasibility study. We're going to be looking at a single floor, circa 2,000 square meters, because that's a good economies of scale for a co-working style business. We're going to go through the floor plans. So I've created some bubbles to show you the different product mixes that should go into it, even a simplified financial model, which you actually get a copy of as part of this, this exercise. And the reason for that is I believe that there needs to be a lot more transparency when it comes to co-working and flex in commercial real estate, especially if we want valuers to look at this business as something that elevates assets and not potentially just, a risky business because it's variable income at the end of the day. And I'm really excited to do this video genuinely because we've got a couple of experts that we're going to dial in as part of the process to kind of show you, even when we do revenue projections, when we look at costs, how we loop people in the right areas to get a proper FISO done. Now, my name's Tashi Dorji. I'm the head of Flex at JLL across Australasia, and this video is brought to you by essensys, which is the flex workspace tech company that transforms good spaces into great spaces. So why don't we just get started, because I'd love to dive into the floor plan, and we can kind of talk through what a 2,000 square meter layout looks like. So we've got a 2,000 square meter floor plate here, and the gray areas are the lift cores and the facilities. You start with your concierge and your front of house area. So what does that look like? Because it also is important from a staffing perspective, which we'll get to. And then obviously, if you've got a back of house entry, if someone knows the space, they've got an office, what kind of breakout area or lounge space can they chill out in? So those are the blue areas here. And I've got some look and feel imagery to kind of give you an idea of what that could look like. You've got your enclosed suite. So this is the bread and butter, which will come to light when we look at the financial model for any co-working or flex-based business, because they're private offices that generally license and sell for 6 to 12 months at a time, right? So they help underpin the income of that floor. You also have some open plan desks. So these are the dedicated desks that are kind of not in the offices, but I think are really great from a design perspective to help the floor plate breathe. Fun fact, a long time ago, there used to be way more open plan desks within these co-working and flex floor plans because they were treated almost as a mini incubator for the offices, but that never really transpired and they just sat empty. Actually, while on this, I think I'd love to explain to you how we came to that quantum of bubbles on the floor plan. So maybe I'm just going to jump over to my iPad and write a couple of things for you. So when we're looking at a 2,000 square meter floor plate, we're going to use a desk density calculation of about 6.5 square meters per workstation. And this is almost a bit of an industry standard when it comes to Australia. This can ebb and flow down to 6, up to 7. It really depends on the size of the space you have and the floor. Like, are there columns there? Are there awkward corners? Is it a shape that's difficult to kind of, build around the facade, et cetera, et cetera. But we'll start with 6.5 in this scenario. So if you divide 2,000 by 6.5, you get about 307 desks. Now the question is, how do you divide that metric into how many goes into a private office in an open plan? Really is market specific, but if we're looking for a very healthy commercial outcome and a reliable source of income, a split I like to use is 85% to 15%. So 85% to your private offices, 15% to your open plan. And that equates to about 260 desks into the private offices and about 47 within the open plan. And I think that's important because that then also translates, even if you're doing very early bubble diagrams like we're kind of looking through now, how you split up, how many of the office's desks do you have versus the open plan and where they should go on the floor plan, especially when you start consulting your design team about that. The 6.5, while I'm on it, actually, just to help explain why that's not literally 6.5 square meters around a workstation. That's more of a calculator because it accommodates things like circulation, fit out buffer. So making sure that you have door swing clearances and stuff like that. Your staple amenities. So what you'll realize is as we go back to the floor plan, there's going to be some meeting spaces and concierge areas and all that kind of stuff accommodated because the 6.5 accounts for all of those things that go into a general co-working or a flex layout. Okay, so we're going to jump back into the floor plan and keep talking through the bubbles. So the next ones are the bookable meeting rooms. This really depends on, do you have a floor, in this case 2,000 square meters, in a small building or a large building? If you've got a larger building and that tenant community desires more bookable meeting rooms of certain sizes, you could argue for having more of these. When we get into the financial model part of this video, you'll see how I measure the utilization rates of those bookable meeting rooms, because it's a tricky spot to be in. They actually make more money dollar per square meter than the offices and the desks and everything like that. But when you think about it, they're sold on a per hour basis, not monthly or yearly. So that's seasonal income. It can be great, it can be bad. I see a lot of pitfalls in feasibility studies and spaces that have been built where they've relied way too heavily on that meeting room income because they forecasted it to be full most of the time, when the reality is there's a very conservative percentage you should be using, which we'll get into. In this floor plan, the bookable meeting rooms are separated slightly because they're still central to the concierge area, because you got to think about how your on-site staff can turn over and service those floors and help out in an easy way. But if you're dealing with multi-floors or a different looking floor, it's best to kind of keep those types of rooms together from a serviceability perspective. The purple ones that have just appeared, which are also seeming to be meeting rooms, these are more of the informal meeting rooms, right? So open booth areas, things that you can get a bit creative with AV, phone booths, all that kind of stuff. Really important when it comes to any flex experience or flex floor plan or co-working, that is, because the bookable meeting rooms, sure, you can give some of them for free and you charge for it, but it's really nice to have those free amenities for your members also. We've put an event space in the top left-hand corner because, you know, generally speaking, when we look at co-working or flex, especially if it's for an investor or a landlord in their building, a big portion of their tenant community is asking for some form of bookable event space, because that means they don't have to put it within their own tenancy. And this also means if it's in the co-working floor, the flex floor, it'll be serviced by a community manager and a concierge within our team, within the flex team. And that event space, you know, should be designed to be multi-purpose. So not just for corporate, general, like, you know, lectures and things like that. And not even for, like, you know, wellness and yoga. That's pretty typical. Imagine if you designed your event space to host like a fashion walkway that can be set up and down, you know, like a catwalk. You know, think a bit different there, because the event space, again, you can't really account or hope that it's going to make a lot of money, but you could really optimize it if you design it thoughtfully, right? So it's not just a build it and they will come, build it for a certain audience. You've got your operational spaces, you know, it's always important not to forget those, your printers, maybe even, you know, a small office for your team that are delivering it. And we've just kind of chucked in some amenities in different areas, whether it's kitchenettes, wash areas, or the top right amenity. That really could be anything that's specific to your tenant community that they've been asking for. You can experiment a little, right? I think, for example, something that I think is quite prevalent right now and is industry agnostic is a media room. So aside from just having a podcast room where people film, not film, but record the audio only, it'd be really cool to have the video content too. Or is that somewhere where they could shoot products and all that kind of stuff? And the last image that I just chucked in there is the circulation. Again, coming back to that density calculation, that's the circulation I'm talking about. You know, 10%, 15% of that NLA, of that 2,000, is allocated in a way to make sure people can kind of traverse your floor in a nice way. Right, and coming back to the open desks, you can see even though the circulation looks like it's a bit of a maze, the open desks, they're not facaded offices and all that kind of stuff with partitions. You see through them, so you get that nice little, like, you know, distance view. As human beings, we like that too. And a note for myself, there wasn't anything else after that. So that's the end of the floor plan. And I think now's a good time to jump into the financial model, where we can kind of make sense of that. And the cool thing is that it's all related to the bubble diagram that you just saw. So the product mixes that I'm going to use in the assumptions are loosely represented by the bubbles. All right, so we're looking into the financial model. You'll see a lot of the rows and columns are hidden to keep this simple, because it breaks down into a lot of detail. But the engine is what's fueling the simplified model so that we can talk about it very frankly. So if we look at the top, I might zoom in a little bit here, because we're going to look at the key performance assumptions. And these are some of the inputs that'll help tailor what kind of business you want to run from a commercial outcome perspective, what kind of product mixes you want in there, from a desk to meeting rooms, all that kind of stuff. And again, you get a copy of this where I've thoughtfully tried to keep the inputs within a range of choices so that, you know, you don't put things in there that aren't feasible from a co-working business angle. all right? So if we start at the top left and follow my cursor here, you've got your 2,000 square meters. We just talked about this earlier where you've got a density ratio of about 6.5 to get to 307. I think I've built in here, yeah, I've got a formula here. If you, for example, put 1,400 square meters, which is the size of the last couple of sites that we've delivered as the JLL Flex team, you can see how the desk density ratio automatically changes. It's because as you get smaller in size, you get less area to allocate to your desks because all of those other bookable amenities or concierge areas or staple things that you need in a co-working layout, you don't necessarily just scale and keep reducing them in size because that could provide a pretty poor experience. So the density ratio changes based on the size. Depending on what market you're watching this in, because I'm speaking to Australia and in square meters, but you can get away with densities as low as 5 to 5.5 square meters per workstation in markets like Hong Kong and India. You know, it's very, very different depending on where you're looking at this. So just keep that in mind. Private office to open plan desks. This is based off the 85-15% ratio I used. If you're looking in a suburban market, right, you're not necessarily in CBD, you could change that ratio to have slightly more open plan desks because you realize you've got a demographic of customers that want it. But always remember, they're not necessarily buying those desks, in my experience, 12 to 24 months at a time. That's more of a month-to-month scenario. So do you really want, 30-40% of your desk income pegged to customers that could leave tomorrow, right? And that raises the real importance of retention. I feel like retention is pretty much more important than acquisition of customers in this business, which is a nice segue because we'll talk about pricing while we're on desks, because you're going to be doing discounts to get people in the room, people within your space, especially within that first year. But moving forward, you're going to want to retain them, and you're not going to be able to maintain the discounts that you got them through the door. So how are you retaining them? And that's through the experience, your community engagement, your staff, all that really important stuff. So in terms of the desk pricing, what I've done here for this particular example, let's assume we've done our due diligence. We assume that the desks are worth $900 a desk, right, in the offices. In the year 1 and year 2, I've assumed blanket across this blended desk rate. You're going to have a 25% discount in year 1, meaning you're going to be selling them in your model for $675. And in year 2, we've assumed a 10% discount, $810. And that's important because the first year, you're going to be ramping up from a starting occupancy of like 20-30% for your desks to try and hit your stabilized 80 to 85% occupancy, which could take 12 to 15 months. So how are you going to do that? Discounts, right? Discounts really help. Plus it means that the space becomes really alive, buzzing, there's a community there, so it gets easier to sell the rest of the desks, right? Then the next question happens is, okay, well, if you've done your discounts for the first year or 15-month deals with these customers, what happens when you renew them? You're going to still give them that 25% discount? No, you're going to hope that by then you've given such a good experience and they're part of the community, they don't want to leave, so you can reduce it down to 10. So it's always good from year 2 onwards to still accommodate some form of discount. And you'll notice there's no discount for the open plan desks because they're normally sold month to month, not on longer term, so don't warrant an incentive. And there's a supply-demand dynamic happening there. If you've only got 47 in this example, there's not a lot to go around, so you don't really need to discount them. And before I go to meeting spaces, I've got occupancy up here. You can kind of see I've got some, for desks, meeting room and event spaces, different utilization percentages here. For desks, we're conservatively assuming you're opening at 20%, so you're going to do some pre-marketing and pre-sales and pre-hiring to do that. And we've got a 12-month ramp up here to hit an 85% occupancy. The larger your site, the longer the ramp up. You might have to forecast for 15, right? Meeting rooms, before I even talk about the products, I might as well address the occupancy while I'm up here. You're starting at 10% and mature is 25. You should never really forecast more than 25% utilization of your meeting rooms, right? And by utilization, I mean you calculate the number of hours that are available during the work week, minus holidays, minus some of the awkward hours that they never get booked. And 25% is, conservative / bullish, because when you think about it, you're going to be giving away a certain amount of hours of those meeting rooms away for free to tenants or customers. There's going to be a percentage of awkward times it's never really going to be booked, like early in the morning or late in the evening, probably more late in the evening towards the end of the workday. So after you take away all of those percentages, turnover time, blah, 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 25% is a pretty good, solid number. Right, and that number may have to come down if you're not in a large building with a large tenant community that will also take care of those meeting rooms, so you can alter that. And the event space, even lower. I might even reduce that to 15%, 12% in this current forecast that we'll look at, because again, unless you've got a team dedicated to it, it's hard to fill. That space within a co-working environment is more to host stuff and for your customers to use, your members to use. But unless you're externally selling it, it's really hard to keep that momentum going. Like you look at hotel businesses, they've got conferencing and events team full-time doing it. So if we go down to the meeting spaces, you've got your numbers. We've got 1 boardroom, 1 8-person, 2 4Ps, and a podcast studio, and we've got our rates there. We've also got our event space. We've got 1 informal 30-person seated, meaning, it doesn't necessarily have to be closed off dedicated. We could do something creative with that space as well. And on-site staff. So I've got 3 budgeted in here, which will be reflected in the numbers we go in shortly. 1 center manager, 1 community manager, 1 concierge, all very important roles. I think I've also built in here, if you go less, it turns like a 1,400 square meter site, you might need 2 people, because the concierge could be a hybrid role of a community manager / concierge. All right, so those are some of the key performance indicators. Let's have a look at the numbers now. So we'll scroll down here and I'll talk you through each of these. Pretty quickly revenue actually, because we talked about the key inputs, which is the main driver here. And all this stuff is calculated for you in a simplified way. You might see some of the rows are locked away, and that's for your ease of use, so you don't get bogged down by all of the crazy thinking. But if we have a look here at year 1 and year 2, before I even dive deep into the numbers, you'll see the average desk occupancy in year 1 is only 53% versus year 2 it's 85%. That first year is really important because you're ramping up, okay? We've got a escalation percentage of 4.2%. I've got some comments listed in here that'll help you when you look at this. And that's mainly driven because the rent in this scenario is assumed to be escalating at 3.7%. So all the costs we've assumed are going to escalate at 3.7%. Just behaving entrepreneurially, bump up your revenue and your pricing assumptions by 0.5%. Stay in front of it, right, as a business owner. I've seen operators and owners bump it up by a whole percent, so they'll escalate their revenue by 4.7%. where their costs are 3.7. I think that's slightly too aggressive. Just keep it at 0.5%, okay? We'll look at year 2 when we break it down, because year 1, you're gonna see numbers reflecting a ramp up, so not true to a base like a mature site that's running at 85% occupancy, but it's good to know to see how it ramps up when you look at it yourself. So we'll jump to year 2. Actually, before we jump to year 2, year 0 is just important here because this, when we get to the cost, represents how much money you need to set up the space to hit that 20-30% occupancy, opening occupancy, right? Primarily it's pre-hiring staff and pre-marketing and all that kind of thing. So we could probably glaze over that. So we'll go to year 2. If we look at your flex space revenue, you can see majority of it comes from your private office desks, right? Which is pretty obvious. And again, important for a business, also important for valuers to hear, because that's a reliable source of income. You're licensing and selling those desks 6 to 12 months at a time. In fact, a lot of data across many operators, because the target customer and demographic is more of an enterprise customer now, they're actually licensing it for longer, 2 to 3 months at a time, as long as you price in those escalations. Your flexible office desks, those are your open plan, a lower quantum of space, therefore a lower amount of revenue. You've got your meeting space revenue, which we just talked about how the utilization rate should be no more than 25%. Ancillary revenue is an important one because sky's the limit here. Some of the more established brands make much more on this because they've got a very good virtual concierge service running across all of their sites, but they have to spread the love, of course. But this could be, even registered mail. You could get a bit forward thinking here, and it could even include sponsorship revenue. So when you think about it, you've got a very engaged community of users, and as long as you don't abuse that relationship, those eyeballs are way more important and way more valuable than just random ones across the internet, right? So you might have certain brands wanting to get their workplace products in front of them and blah, blah, blah. So I see some of that becoming prevalent within that industry. And your event space revenue, this could be turned on to make a lot more money, but we're being very conservative, right? This is assuming you'll book it every now and then because someone wants the space and will pay your rate. But unless, again, you've got a dedicated team doing it, I wouldn't assume too much. Actually, now's a great time probably for me to throw it over to Jim from Rubberdesk, because the revenue assumptions, aside from your product mix, it's really important to get your rates locked in with the right amount of due diligence and understanding the competitor analysis in the market and all that kind of stuff. So, Jim, could you explain this for us in a few words, please?
Thank you, Tashi. So I guess trying to figure out the right price for your office space shouldn't be guesswork. But at the same time, it's probably not an exact science either. Um, there's no single formula that will give you the right number to charge customers. But there are probably some steps that you can take and go through to help validate and get close to getting the numbers right. My name's Jim Groves, and I'm the co-founder of Rubberdesk. We're a flex-focused broker for office space. We deal with lots of customers that come to us looking for office space, and we show them all the available options in the market. So I guess my first point of call is to say, have a look at the data. Have a look around at what else is available based on location of similar quality in terms of building and fit out quality that's nearby and in the market and along the same size and capacity as your offices to get an idea of what you'll be competing against. Secondly, let's have a look at the type of target market that you're trying to go after. Are you looking for corporates, for creatives, for agencies or lawyers or in healthcare or NGOs? Because the type of market that you're going after will affect the requirements that they might have of the space itself, and also the cost and the price that they might be willing to pay. To do this, you can look at certain attributes of the building itself, premium grade, A grade, B grade, etc., and the mix of tenants within that building currently. So you might already have an existing building with other tenants, and you'll be able to gauge, well, what's their makeup. So we've got the competition. Have a look at Rubberdesk, see what's around. We've got your target market. Have a look at your internal metrics and who else is in the building. Then you might be looking at, okay, well, how do we bring this to market? What's our go-to-market strategy? For this, I'd suggest you engage as many agents and brokers to come around and have an inspection before any construction's begun. Get them to come in and see the space itself, look at the renders, look at the floor plans, talk to them about your expectation for rent on a per desk basis and for occupiers, and engage and see what the reactions are. Oftentimes, if you can get a tenant in before construction starts, then you can build something specific for them. It makes it very appealing. It takes some pressure off sales as you go, and it gives you some confidence that you're getting the pricing right. Next, have a think about the pricing strategies that you might use. What's going to be included? Are meeting room credits going to be included? Is printing going to be included? Is there a setup fee? Is there a make good fee? What these might look like and what these incentives might look like. What you might be able to include for with customers who might come as for an early bird discount. Might there be 2 months rent free or a month rent free? These are ways that you can give value to your early adopting occupiers without having to reduce your rents and hurt you. Finally, I'd say test and validate all of the above assumptions. Look back at your early assumptions of who your target market is and compare that against what type of tenants are inspecting the space. Is it matching? Are you getting the kind of tenants that you'd hoped for, or was that assumption off? And then adjust and readjust. And remember, keep checking on Rubberdesk, see what else is around, and talk to us about when it comes to taking it to market.
All right, co-working revenue, it's deliberately zeroed here, and I'm not going to get into this too much, but if you're going to put a co-working cafe within your floor and it's not on the ground floor where you can take advantage of street traffic and run that business properly, almost like a restaurant cafe, assume it's going to lose money or at best break even. So the purpose of a cafe here especially if it's, as I was saying, like an on-floor within a building, is to enhance the experience, which can help justify charging higher desk rates, meeting room rates, and everything. So that's where you get that additional income within your model, right? It elevates the other product offerings. But if you are going to model for it and you want to look at your COGS, your costs, your uniforms, your staff, all that kind of stuff, yeah, so you could almost blank it out and just say you're going to put one in there because it's going to probably cost you a bit of money. Even if you bring in an expert, I've seen models and operations where they make, 10% margin tops, and that's being run by a proper food and beverage operator, and they've got some form of ground floor presence. The way you can make that actually more attractive is if you have a commercial kitchen and you're catering into the building and it's big, and then you can talk because you've got more channels of revenue and you've got economies of scale there. But that's for another video. Costs, let's have a look here. So the key crux of these costs, you've got, in year 2, you've got close to $2 million worth of costs. The first major breakdown is your operational costs, which I've broken down into property costs, flex operational costs, overheads, and broker commissions. Property costs, this scales with the amount of space. This is your repair and maintenance, your utilities, that kind of stuff. Flex operational costs, this is important because it's your flex software. What are you using from a technology perspective from bookings and buildings? Also, it's your activation. So what are you doing from a community perspective and budgeting it, how you're leveraging your spaces? Overhead costs, and I'm shortly going to bring in some experts to speak to some of these nuances. But overhead costs, that's your on-site staff. For this scenario, we've budgeted for 3 people for a 2,000 square meter site. It's your annual marketing. So what are you doing every year to get those leads coming in? And your broker commissions. I often see this excluded, but you have a lot of agents coming in with flex leads. So if your center manager's not doing it, or your community manager, but they're converting them, you got to accommodate that, 10% commission to whoever brings that lead in. So that could be nil, but have something in there. I think it'd be a good time to throw it to Dan from Spacenow, because he's going to talk about really cool creative ways you can activate your spaces, not just in the flex space, but also within your building. So Dan, take it away.
Hi Taj, thanks for having me. Yeah, so we've seen the rise of creativity integrate into the corporate market. We've seen a lot of building owners wanting to activate, say, their foyers. So what we did was, because we work with both artists, musician, fashion, and general creativity, we brought all those groups together and have activated foyers, which made it very, very interactive, both for the internal tenants, existing tenants, but also helped to bring outside people within the building. And it turned it into a really community space. It was very intriguing. It was a space which made people want to come back and spend more time. And I think that sort of helps with securing the value of the market, of the office space and that community. The other thing that we've seen is, obviously nobody likes to see a dead space, especially something at the bottom of a building. So we've come in and activated these dead spaces. What the beauty of this is, you see multiple brands coming in and out. There's always something new. It creates activity, and there's obviously the opportunity for long-term tenancies out of it. So really, this integration of creative short-term activation is really entwining and becoming a very, very big value add for any major office and building owner.
Now, so you also get a further break from me. We're going to throw it over to Jessie from WOTSO, because she's doing some really great stuff within the market, and I'd love for you to hear how she approaches, experience and the way she runs her places too.
Thanks, Tashi. I think it's really funny that this topic is coming up, as it was only the other week I was chatting with a shareholder of ours around teams and community, and how do we know we can replicate teams and community at scale, in particular with our hyperlocal approach and being so spread out across Australia and New Zealand. But I think before I sort of dive into the hyperlocal approach, I wanted to go back to this discussion around that's been going on for the last couple of years around this flight to quality. And my view of a flight to quality is more around providing a seamless experience. If you turn up and things don't work, it doesn't matter how good your member experience is on site, people are going to leave. So my view of a flight to quality is actually making sure that everything functions, that you can get in the space easily, that the internet works, that it's clean, that there's someone sitting at the reception desk to assist. It's not so much about whether the building is an A-grade building with a high quality fit out. In particular, that applies to us, given we are putting spaces close to where people live, not in CBDs. I think, though, at the same time as, discussing this seamless experience, it's also about testing what you're providing and making sure that you're getting a return on that. We have to be able to balance making a profit and a seamless experience. We want to be around for 50 years, not just 5. So everything that we're doing is with an intent to ensure that, people on site are experiencing, a good space, but at the same time, we're making sure that we're not doing things that, cause our bottom line to go into red, and trying to speak as transparently as possible on that, I guess. I sort of previously talked about targeting suburbs and regions and having this hyperlocal approach. We've got a goal of creating, 100 sustainable communities across Australia and New Zealand. And I think when you're trying to be authentic at a local level, that's super hard to scale. So we've looked towards, centralising certain parts of our business, which, is obviously super efficient, but when offering local spaces can really impact the community. So we've tried to go for sort of central principles with local execution. An example of that is, our sales teams. So our sales are handled by our site teams. We don't have a centralised sales team. And all of our team members are able to handle their inquiries with their own style. And we have a policy that all, inquiries sort of need to be responded to within an hour. What we found, though, is that as we've scaled, we've started creating templates for responses, which removed a lot of what was making us authentic. So recently we overhauled everything. We ripped up the robotic responses and we started using AI instead of to create templates, but to research the business. And I guess, it's finding out, is the person that inquired the CEO, or are they the EA, or do they have 5 offices across, Australia? Did they not have an office before? So we know more about the potential member before we are responding to them. That will be implemented across our training program, and I'm interested to see at how our conversion rate shifts once we implement that. I also think I was so impressed when at GWA in Chicago, when Geo was talking about a particular operator there that had a CRM system that was taking into account the members that they had in their space, when their birthdays were, when their anniversaries were, if they, won a local business award, the celebrations that those people might have personally, but also professionally, and making sure that they acknowledge those and acknowledge them without prompts. So that's our goal. I'd love to get to a position where, at each of our locations, we know everything about our members. We're selling to these members every month. Our model is a monthly model. You only have to sign up for 30 days. So it's so critical that, if we are, that we sell to these people each month, that we know as much as we can about them. I think to round out community and member experience, for me, it comes back to making sure that you've got the basics right. The internet and tech works, the space is clean, the door access works, they can find a car spot. And it doesn't matter, I guess, how good a CRM you have and how much you know about your member. If you haven't got the basics right, you can't build a community to start with. So yeah, that's my take, but I'll pass back to you, Tashi.
And the technology piece is really important, not just for the flex of the co-working space itself, but for the rest of your building. There's been so many scenarios where, because our co-working team goes in a building, there's an aspiration and a desire for us to be able to service spec suites or vacancies within the asset. So what does that look like from a technology standpoint? I think that's a really good opportunity to throw to Sean from essensys to speak a bit more about that.
Thanks, Tashi. So as it relates to technology and I guess sort of digital infrastructure, really as an operator in whatever structure or form the co-working space or the flexible spaces may be taking, you want to start with the sort of foundational element of building something that suits both your space, but potentially the additional amenity spaces in the building and even other turnkey spec suites or spaces across the entire asset. The reason being is obviously they're two very different solutions as far as multi-tenant and sort of traditional lease space. And a lot of the solutions that you can put in place for your co-working space will naturally flow downstream to meet that sort of broader addressable market. What that looks like, I guess, sort of as you're running through the feasibility and as Tashi and these other experts will have spoken to, you want to be thinking about the enterprise users' demands, but obviously every member and end user experience sort of at the core of what you do. And the reason being is obviously large corporate occupiers have quite stringent cybersecurity and technology requirements. So granted, it can be sometimes quite a large threshold to sort of meet, but if you can get there, you should have a very large market to target as far as the members using your space from sort of day one. What that can look like from a tech stack perspective is you're going to want some software to run the space management elements of your space. So that would include member communication, events, all of your billing, bookable spaces, and sort of the app that might sort of help run those spaces. And then the digital infrastructure or sort of the underlying foundational layer of what powers the sort of space writ large. And when we reference that really in sort of a layman's terms, you're looking at the connectivity and then the access, the physical and the digital access that allows your members to really easily use the space. Where again, it'll be very market specific, it might be building specific, but what you can do is look to partner with other groups. You can do it by yourself, of course. You can look to partner with other groups who may provide sort of like a project-based, sort of consultancy-based service, or you can look at sort of service providers that can sort of wrap a whole bunch of this up for you, and then even to the extent where lots of different software and platform providers will have pre-existing integrations in place that sort of make a lot of that easier beyond just the feasibility and the delivery of the space, but the ongoing management of it, right? Because that's really where the rubber hits the road. Some of those challenges really, again, looking at a multi-tenanted space, right back sort of to the build out perspective, you've got to think Wi-Fi is really best when it's sort of unencumbered by lots of walls and doors and windows and additional spaces sort of that wouldn't be in a single occupier's floor. So right from the design stage, you need to be thinking about what does your current design, as you may have got to from the sort of feasibility work and the market sizing and all the sort of feedback that you've received, what does that actually do to the digital experience and the Wi-Fi connectivity across that space? And again, that can be quite nuanced in its nature. You then want to also think about the onboarding process. How can it be as low touch, simple, seamless as possible, again, while still meeting the more stringent requirements of, say, a large financial institution or any large corporate who may be interested in taking a big chunk of space or even a small sort of touchdown space for one of their teams. And I guess the challenge there is whether it's 150 desks or 5 desks in a sort of regional space that they might be looking at. most of those larger occupiers are still going to want to see the same sort of threshold met as it relates to security and their requirements. At the end of all of that, really, when you've got an idea of what you want to deliver, who you're trying to target, what your budget may be, you really want to ensure that what you've built for your first site or maybe one of your initial sites has the ability to scale and provide a consistent sort of unified experience across a portfolio as you may expand. Technology by its very nature can be complex, and what many operators and landlords for that matter sort of looking to offer flex solutions can occasionally sort of get unstuck by is a bit of a Frankenstein's monster, or sort of a mosaic of solutions, which, while maybe fine in the low single digit numbers of sites, as soon as you're looking at sort of portfolio scale, whether that be sort of half a dozen or 10 plus, it can really become a challenge to sort of manage that on an ongoing basis, given again the complexity and all the different sort of systems and solutions that you might be trying to manage at one time across a portfolio. And I think that's, maybe sort of a tech 101, and back to you, Tashi.
Okay, back to the model. So you've got your co-working cafe costs, which I've zeroed for what I was speaking to earlier. We've got your building outgoings, your triple N costs built into there. Now we've got a base rent hurdle. So I probably should have said this earlier, but this model is based off a hybrid management style agreement, which we're seeing a lot in the market these days. And in this scenario, let's say the target rent is $800 a square meter. We've agreed that 400 of that, so about half of that, is going to be a base rent hurdle, right, for the operator to pay for the landlord before we start talking revenue share, profit share style arrangements, which is important because it gives the owner some confidence that, okay, even if it's a waterfall payment structure, that's going to come out first, right? Then we look at the flex management fee. We've assumed it's around 6% revenue for a site of this size, and it's important to dictate that that's 6% of the flex revenue. So if you are baking in your food numbers and everything like that in there, you don't take a percentage out of that, because food and beverage revenue is an extremely high number, but again, low margin, right? So take that percentage only of that flex revenue. That's circa 168K for the operator. Okay, now we're at the profit pool and profit share. Because that pool is smaller, because we've taken out outgoings, a base rent hurdle metric, the percentage distribution between the landlord and flex operator in this scenario is 95% to 5%, right? Which means the landlord gets majority of it and the operator gets around circa 40K for an 85% performing site. This is important because if there is no base rent hurdle and you're just doing a straight up revenue share, profit share style scenario, that profit pool is going to be significantly larger, right? Which means that percentage could even be lower. So it really depends on how you approach profit and how you're willing to calculate it. Now, I've equated this to total income in terms of gross rent to help you understand, if you're a landlord watching this, what could this look like? If your target for this scenario is 800, that doesn't mean it's 800 in year twos, with escalations, it's about 830. Under this assumption of this model, you're looking at around $916 per square meter back to you. So the delta is plus $86, right? And this is if the site's doing well and everything goes according to plan, which happens, I'd like to say most of the time, but this is why you budget very conservatively, right? And even though it's a higher rent, it is important, and it is a healthy higher rent for you in this scenario, because under a management style partnership agreement, the landlord is on the hook 99% of the time to pay for the capital, right? Because the whole point of this partnership is for the landlord to build something that looks and feels like their space, is part of their building, likely branded their building, hence they're putting that capital up front. So if you want to look at that capital ROI or payback period, you need something slightly more than the rent than you would normally have put to market. It's kind of like one of the premiums that comes with flex space. Obviously, this is going to be dependent on what market you're in, what area you're in, what building you have, construction costs, all that kind of stuff. We used to build spaces at $1,500 a square meter 5 years ago. Now you're lucky to get it at $2,300, even though that's what the model says it is there. So that's food for thought and something important to consider. And yeah, as part of the model that you'll receive, I've showed you what the cumulative cash flow to the landlord looks like. In this scenario, they're getting their payback, very early in year 4, and you can kind of see the cash flow to the flex operator on the bottom, assuming they keep things running, moving, and doing well. So hopefully that was helpful. I think the flex model will help make a lot of sense for this. And also when you look at the model, have the floor plan next to you as well, because you're like, oh, so this is kind of what the floor plan looks like. And that's important because if you wanted to make more money, then in theory, you take away some of the amenity areas and you put more offices and the spreadsheet looks even better. But just remember, if it starts turning into an ant farm, your pricing assumptions will go down, your experience will go down, and you probably won't hit your occupancy targets. Inversely, if you take away some offices and you put more amenities in there, but expect a lower rent, you might find that you're hitting a higher occupancy percentage, or the value that the flex brings is reduction of downtime within your building, right? So that's the play there. So hopefully that was helpful. And if you liked this video, please let us know somehow, because we're willing to do more of these different scenarios and willing to give out more materials and tools out there to help everyone out there. But thank you for listening. Thanks for your time and attention, and I'll speak to you again soon.